All right, everybody. So today I'm going to have a quick lesson and then go over the markets. So this is continuing my discussion on springs and upthrusts. So to better understand this, you need two pieces of information. All right. So the first thing is trend. And what you're taught about trend is oversimplified, that it's higher high, higher low. Right? This is one of the things that you're taught, but obviously we have trends that do this, trends that do this, trends that do that, trends that do that. So there's still an uptrend, but you see that you have, in this oversimplified, you have higher high, higher low. In reality, you have both lower high and lower lows. It's just the general direction of the movement is up, all right? But you have lower highs and lower lows, and then what you'll hear is about internal and external liquidity, but that's all just, in my opinion, just an excuse, because you have higher high, lower low, then a higher high, and what they'll do is they'll just make this whole thing seem like it's one leg, when clearly it's not. So the higher high, high low definition just doesn't stand, because you have internal highs and stuff like that. Anyway, long story short, the reason why I'm bringing this up is not because of structure, but because of a key attribute of trends. This key attribute of trends is more than just structure. It is this fact. The fact is that breakouts fail in downtrends. And breakdowns fail in uptrends. This is a key characteristic of trends, but you'll never hear this talked about. You just won't hear it. What you will hear is this oversimplification of higher highs, higher lows, but never about the failure of breakouts and breakdowns. In the books, in online and all that, you never hear this piece, but this is critical information and a key characteristic of trends. It is basically also the premise of certain patterns like your A, B, C, which attempts to break below A only to get reclaimed and go higher. Why? Because of this second reason, that breakdowns fail in uptrends. So C tries to break down and fails, and you get your next rally up. Right? So it's important to note this. Now, with this, basically what you see is the spring is this failure. It takes advantage of this characteristic because a breakdown fails in uptrends, and that breakdown attempt is sprung. So it's a spring, and this is your upthrust. Upthrust is a breakout attempt in a downtrend, and a spring is a breakdown attempt in an uptrend. All right, so upthrust is a failure breakout. Failure is a breakout attempt that fails in a downtrend, and a spring is a breakdown failure in an uptrend. Of course, you have to have buying and all of that. So I don't want to get into all the minutia, but that's the idea. You don't really need all the complex definitions. And also note that the more traditional thing that you're taught is that a spring is at the bottom of a trading range, bang, and then this, and all of that. But this exists on the way up, right? Because you have spring in an uptrend, and this is actually a spring in accumulation. Right? So we're talking about spring in uptrend, which is that spring in markup or accumulation is in the traditional sense. You have spring in accumulation or an upthrust and distribution. Right? Right? So this is very important to note. If you understand what I'm doing, you'll understand how valuable it is. And I'll show you today how valuable it is. But there's another thing I need to explain. Typically you hear about these different types of springs and all of that, right? But there's a really, really important thing to understand with spring is another concept. With springs and upthrust, you must understand another concept. All right? So the concept that's extremely important, I think the term is inducement, right? I think that's the term. Some say a probe. I've heard. But the idea is that you got to get them in and then get them out. All right? And you get them in using breakouts. I'll explain how this works. The idea, you have a breakout, turns into a rally, right? The breakout. Now, price pulls back, makes a higher high. This higher high, I've heard of it called a probe or inducement, but the idea is you first make a higher high, then do the spring. Then screw everyone. All right, so it takes out both sides, makes a higher high to get them in, spring to get them out, and then goes up. Now, there's reasons for this maneuver, but the real, the key is that if you make a higher high, the stops will be here. That's where the stops are going to be. So it facilitates a stop run. Because that's the logical place to put it. When you put it, go make a higher high, it's going to be at the higher low. It facilitates the stop run. And two, if you go here, they go short, and you go the other way, it facilitates short covering. And one of the best ways to make a market go higher is short covering. Because short covering is like a trigger for the orders to keep coming in. You go down, go up. As soon as you go up, they cover, and it pushes the price higher because of the covering. It's one of the best maneuvers to force prices, force the price to go up when they have to cover market. So that's what happens. And in the case of an upthrust, a breakdown on the downside, rally, you get 1, 2, see? They make a lower low first. This is your probe or inducement to the downside. Then do an upthrust. Then go down. Okay? So now realistically this is basically what you're going to see. This is a double pullback where the upthrust or the spring occurs on the second one, but you can have it's either this one or the second one is they just do it like that, and there are two highs that get taken out. So, and this happens when this is a lower high. When this is a lower high, then this higher high upthrust occurs. And then price goes down. Now, for Wyckoff style traders who use waves, you can see this very clearly. For others, they won't be able to see it clearly. But for Wyckoff style, you have all indicators and signals that show you this. So that's how I can see them, and I, to a degree, can forecast that this was going to happen. Because I see this all the time. So this is what happens. Because of the waves. The zigzag waves, they reveal the breakout, the rally, the pullback, the inducement, the upthrust, and the spring. So that's why it's one of the best indicators in technical analysis is this zigzag, because not only will it also show you the trend, but it'll also show you the support resistance points that are targeted. Anyway, so I've just explained how this works and how it's done. So this is the second one. This is on the third leg. This is on the second leg. This is on the third leg. Usually one of these two happens, but in any case, afterwards it should be a big move down. So, and it's almost that these two things are required, especially that short covering, or the panic selling, which is the opposite of short covering, to make price go down. It's like the market needs that to start the fire, to start the move. It needs that covering. Those market orders. Now we'll see. We'll see examples. I'll show you. So this is what is it called? This is the ES. So you have a break, follow through, becomes a rally. Now there's the first pullback. Second pullback is a lower high. Okay. So these both are going to get targeted. First, it's going to probe, so it goes below the second pullback. It didn't go below the third pullback, it just went below the second pullback. It's fine. It needs to make a lower low. Remember, you need inducement and the covering. So they're in right here. Why? Because it broke this low. Right? It would be even more devastating if it went down here, because then they would be short here and there. They'll be short here and below here. But it's good enough. It makes a lower low. Now it's going to be that higher high up thrust. Bang, right there. And what happens after that? Drop. Right? Now it hasn't taken this out yet, so it probably will, but I wouldn't be surprised if it just goes up and does it again. But typically this would be enough orders to break this low. Right, and on this upthrust you get supply. See how it takes out both sides of the market, make a lower low, then the higher high, lower low followed by a higher high, and then breaks that low. Lower low followed by higher high. Takes out both sides. That's the key, both sides. Why? Because you are taught higher high, higher low, or lower high, lower low. Never taught that you could have a higher high followed by a lower low, which leads to the breakdown and a new rally. And ask yourself why you're not taught that. Right? We'll take a look at another market. This gold. And remember, you need trend, otherwise it's not going to work. So what happened is, this one's actually a little bit harder. Yeah, I mean, you had this low taken out, then this high, now it's ready to go. But the reason why it didn't crack here is because you have these highs that were never taken. This high takes the stops above these highs. So now this is in a precarious position, right? So it goes down, making lower highs, but never took out these prior highs, and that's what they targeted. And when they do that, this is what happens. Right there. Bang. Nails it. Test. Now we'll see how low it goes. But it cleared this area. So get them in. Get them out. Now we'll see if it cracks. Right? Induce, shake out. Or get them in, get them out. Get them in, get them out, and you're ready to crack. Alright? So you see this all the time. It's just, you see this all the time. For example, here you have a high. You make a lower low, right, to 42.10. Now, what happens after that lower low that goes to 42.10 below 42.15? You have a higher high. So this is your probe or inducement. That's your upthrust, and that's your break. Same thing. Anyway, I'll give some examples also. Yes. See, in the uptrend, we just analyze the uptrend. Spring makes a higher high right here, right? Makes a higher high. What happens after that? Lower low. See that? Higher high, internal higher high. Not really internal, but coming from internal. It makes a higher high followed by low low. Why? Why is it that it's making a higher high, higher than the rally, only to make a lower low. You see, you taught higher high, higher low, but it's higher high, lower low. Again, higher high, lower low. Same thing here. Rallies, higher high, lower low. And it goes on its way. Even here, it makes a higher high, lower low. There we go. Makes a higher high, only to make it lower low, and then rallies. Same thing. Higher high, lower low. Then does one more lower low and then goes. So it does that over and over again. And now on the downside, you have a lower low followed by a higher high, and now the break is expected. See, because that's the way the trends really move. They don't make higher high, higher low. Everybody be filthy rich. They have to shake out. They have to induce, shake out, then they go. They induce, shake out, and go. And the only way that's done is by get them in, get them out, then go. And the reason in my opinion, this is done is because they need that covering. Because the covering, and also it offers good price to get in. For example, if you go above here, you have breakout buyers buying, you can sell into that selling, getting a good price for then price to go lower. So this is a redistribution point. This upthrust is a redistribution in a trend. This accumulation, this spring, offers accumulation opportunity. Why? You have a big bar down, you have sellers. You can take the other side, accumulating what they're selling. So it gives you opportunity to accumulate. Instead of a long base, you can accumulate on quickly. Quick accumulation requires this. Have a breakdown, have people sell a breakdown, take the other side. You accumulated. So this is better than the base. Accumulation opportunity plus short covering opportunity, and then pop it up. So now we're watching the downside now. All right, I'm done. Have a good night. Bye.